All right, so we've done the two different payback methods, and now we're going to do probably the most commonly known one is the net present value in the world of finance. Okay, so the net present value, we've sort of done some of the work for it already, but let's calculate the net present value of this project. So the NPV is equal to the present value of the cash inflows minus the present value of the cash outflows. So in this case, what we're going to do is we're just going to do the present value of each year of cash flow. Okay, so in the very first year, we have a cash flow of $24,000. Okay, but if we want to take the present value, we divide that by 1 plus the discount rate to the power of 1, because it's in 1 year from now. And this is essentially what we did here. Okay, so we took the present value of the cash flow. So if we just added all of those up, we'd get the net present value. But I'll show you the long way of doing it, assuming we hadn't done that part yet. So the second year cash flow was $22,000, and we're going to divide that by 1.15 to the power of 2, because that's 2 years from now. Third year is $19,500. Divided by 1.15 to the power of 3. And then the final year was $14,600. Divided by 1.15 to the power of 4. Minus the present value of the cash outflows. Now this one is simple. Present value of the cash outflows is $50,000 negative. And that's because that was the cash flow in year 0 right here. Okay, and that's already in today's dollars. So if we were to write all of these out, basically it's going to be the same as what I wrote at the top here, but I'll just redo it. So we're going to have $20,870 in year 1, plus $16,635 in year 2, $12,822 in year 3, and then $8,348 in year 4, and then subtract the original cost of the investment. Okay, so we end up with a positive 8674. Okay, so essentially in this case, what we're saying is that this will add value of $8,674 to the company if they do the project. Okay, and the other way of saying is that NPV is greater than 0, therefore you should proceed with the project. Okay, so that is a metric that you use to determine how much value am I actually adding to this company by doing this project, and is it worth doing or not. Okay, so if it's greater than 0, you go ahead and you do it. Now, what is the internal rate of return? Now, I'm not going to calculate it, but the internal rate of return is essentially the discount rate at which NPV is equal to 0. Okay, so remember here, I said that the discount rate that we're going to be using is 15%. Okay, so the discount rate in this case was given. We were told it was 15%. What if I wanted to change that and end up with a net present value of 0? Essentially, the only way I could do that is, through an Excel formula or iteratively or a variety of things like that. But basically, I'm not going to do the calculation, but I will say that the answer in this case, the internal rate of return for this project is what does it work out to? 24.08. Okay, so that is, if you run it through an Excel spreadsheet and you change the discount rate to 24.08, the project ends up as a 0 NPV. Okay, so another way of putting this is that you could say that the project is earning 24.08% per year. And our minimum requirement is 15% per year. Okay, and this is sometimes referred to in finance also as the hurdle rate. Okay, so this was given. We were saying that 15% is what the project must earn. So if it earns more than 15, then the NPV is positive and you proceed. In this case, it's earning about 24, so it's well over the requirement. Okay, so on that metric, you would proceed as well. And then the last one that I didn't really go over was the profitability index. And this is essentially just a different way of stating the NPV. Okay, so the profitability index is equal to the present value of the cash inflows divided by the present value of the cash outflows. Okay, and we've already calculated all this because remember, NPV is going to be the present value of the cash inflows, which are positive, and subtract the present value of the cash outflows. So we've already got that information. If I go up here, well, let me put it down here. We already know the outflows is 50,000. Okay, so what are the inflows? I would just add up all of these numbers here. And as a result of that, I get cash inflows of 58,674. So if I took all of the cash flows for those 4 years and I discounted them to today's dollars, I get 58,674. And then I end up with a profitability index of 1.173. Okay, and essentially the metric for this is if the profitability index is greater than 1, then proceed. Okay, so basically if it's greater than 1, then NPV has to be greater than 0, and you go ahead. So those are the 5 factors that are commonly used in capital expenditure analysis. There's some metrics to look at for each of them: NPV greater than 0, internal rate of return higher than the discount rate or the hurdle rate, profitability index greater than 1, and then the shorter payback period as possible. And then you use your judgment to analyze the projects on a qualitative basis as well. And then that would be a summary of how you make capital decisions going forward.